Hello there. So this week I made a good 5% on my account, and that is with just 2 trades, and I'm going to show you how I did it. So it was on the forex pair of the pound US, and I'm using my favorite strategy, which is the London Breakout Strategy. So here is the chart of the pound US, and this box here shows the high and the low of the Asian session, which for here in the UK runs from midnight to 8 o'clock in the morning. This is on a 5-minute chart, and it's very simple strategy. Basically, you buy when the price goes out the top of the box, sell when it goes out the bottom. And as you can see here, it came out the bottom here. So you wait for a full candlestick to come out the box here. It's come out the box here, and that was at 12.728. And normally what I do is I set a limit on it. So I'm looking for 20 pips, okay? And I'm only going to risk 10 pips. So that's a 2-hour return, okay? And normally I sometimes go for 1.5 return. It just depends on the high and low of the Asian session. For example, this is 12.730, the low, and we're looking at 12.730 up to 12.755. For example, if there was a 40 pip difference there, I probably wouldn't go for. I might go for 1.5 return. The narrower the range, the more chance I think I've got of getting a good 20 pips. So anyway, I sold here, and as you can see, 20 pips, it would probably be around here somewhere, but I started using the MACD indicator, and this is the MACD indicator at the bottom here. It stands for Moving Average Conversion Diversion. It's a bit of a mouthful, but basically what it does is it gives an indication of when the price is going up, when the price is going down. So here you've got 2 lines here. You've got the blue and the red. When the blue crosses the red, you would buy, and when the blue goes above the red, you buy. When the blue goes below the red, you sell. And you see these red candlesticks here, that means the price is going down. And when you see the green candlesticks here, that means the price is going up. And the longer the candlesticks, that means there's more momentum for buying for the price going up. So basically what I did was, instead of setting a limit for the 20 pips, I let it run, and I let it run. And I was following the MACD. So you can see here, the blue line is crossed the red. Following in line with this, it's carrying on down, down, down. Then it starts to go up here. So that's when I sell. Okay, so I don't sell right at the bottom here, but I sell as it's starting to cross. You can see the red bars are dwindling out. Okay, so the momentum for selling is going. We're now going on to the buy, and that's when I closed out. So I manually closed out 12.702, so 26 pips. I got 6 more pips than what I bargained for. This is where the MACD is helping me maximize my profits, and that was on Monday. So that was a good start to the week. Now Tuesday I was actually working, and I don't like to trade when I'm working because I can't concentrate on it, even on a simple strategy like London Breakout. I think I probably would have won by the looks of it. Looking on Tuesday, 8 o'clock, it looks like if I'd sold, yeah, looks like all this lovely downtrend here. These are 5-minute candlesticks, by the way. And it ties in with the MACD at the bottom here. So now go on to Wednesday. So Wednesday I could have traded, I was off. You got a nice tight range here. The range here was what? It was 12.64, approximately 12.81, so 17 pips. Very nice tight range, which normally stands out for a good breakout. But as you can see, it broke out the top here, but that's the wick. Never trade on the wick, because the wick there means it's met resistance. It's liable to come back down again. And even on the MACD, it shows it's going up. But then it soon comes down, not as quick on the MACD. As you can see, it doesn't really start coming down till about here. But certainly you can go by the wick there as resistance, so that it's going to start coming back down again. As you can see, it stayed in this tight range here, just like the Asian session. And it doesn't really break out till about 1 o'clock in the afternoon. Now, for the breakout session, for the pound US London session, you do it between 8 and 11 for the first 3 hours. It doesn't break after that, then it's not a reliable indicator. And as you can see, it starts going up, and then you got this big, there must have been a news report there, I didn't check, it's come all the way down. But I wouldn't have been in the market there anyway. And you can see the MACD. MACD actually is indicating that the price is coming down even before that, so maybe you could have got in there and traded that. But if it's a news report, I wouldn't have traded it anyway. Okay, so then we go on to Thursday. Thursday, we've got another fairly tight range here. Now Thursday is a really interesting one, and this is where I've been using trading stops to minimize my losses, maximize my profits. So here it's just broken out the full candlestick here, and that is on 12,786. Okay, and what's happened is it's come down here, but bear in mind I'm still looking for the 20 pips, risking 10. Come down, it's got about 9 pips. Okay, so then it starts going up in line with the MACD, and what's happened is it's gone up. My trailing stop has come down. Normally I would be closed out because my trailing stops moved in line with the market. It's come down to the break even, so I haven't actually lost anything. And then what I decided to do, which it could have been a bit foolhardy because normally I wouldn't normally do this, I went back into the marketplace and decided, well look, let's come back out here again. Why don't I sell here, because it's still outside the box, and the MACD hadn't quite crossed, but it's you know, the momentum for buying is certainly coming down. So I decided to go back in. I remember I hadn't lost anything on the first trade, so I decided to sell again because it was at the same entry price I had before anyway. And if I'd kept my original stop, basically I would have been closed out and I would have lost anyway. But it doesn't mean that the breakout doesn't work, because what some breakout traders will do is they'll have the stop right up the top of the range anyway. But to me, that's too many pips. I'm looking at my risk management. But this worked out well, because what happened was it did hit the trading stop, but the trading stop had now break even. So when I went back in again, I was still at the same entry price, so I really had nothing to lose. And as you can see, it's come down, it's gone back up again. And then here, in line with the MACD here, you can see here, it's come right down. And this is coming up to midday now, and it's coming right down, and it comes all the way down to here. And I get out here just to see the MACD coming up again. Okay, and so I get out there, and it's like 12.70, sorry, 12.78, where are we, 20 pips, it was 12.7, I think 12.766, and it was 86, so I got the 20 pips in the end, which is what I was after. And if I hadn't gone back in that trade, I wouldn't have got those 20 pips. Okay, I wouldn't have lost anything. Maybe it was a bit of foolhardy decision, but I didn't go straight back in. I based it on facts that the entry price was still the same, and I hadn't lost anything on the first trade, so I was fully prepared that I could lose on that. But bear in mind, I'm only risking 1.5%, so that's where the trading stop really helped me out on that, and that was on Thursday. And then went to Friday, and I couldn't trade on Friday because I was working, and I'm glad I couldn't, because again, I would have been aware of this anyway, because the first Friday of every month is non-farm payrolls day, which is the economic report that comes out of America, which is an employment report, and it highly affects the US dollar. And as you can see here, just in line here with the MACD, you see this big candlestick here. It's come right down. That's about 70 something pips, and that's why I don't trade non-farm payrolls, because you never know. The forecasters say one thing. As you can see, the pound was going up against the US dollar all the way, and then suddenly it comes right back down. So based on that, pound weakening that much against the US dollar, obviously the report, I haven't looked at the economic report, but the economic report that came out for employment statistics were obviously very good for the United States, because the pound has really weakened against the dollar, and that means the dollar's gone up against the pound. So obviously economic report was really good, and that was on Friday. And I'm already planning my trading plan for next week, which I know there's only going to be 3 days with a trade, and that will be Tuesday, Thursday and Friday. Obviously no non-farm payrolls next Friday, so that would be handy. And sometimes Monday's not always the best day to trade. Some people say Friday as well, but yeah, Tuesday, Thursday and Friday. But really the point I'm making here is, you know, the marketplace, be it forex, commodities or indices, like a smorgasbord of things you can nip in and out at different times and trade. And there's that tendency to overtrade. And I'm I'm just showing you that you can make an easy 5% in your account with just a couple of trades. Okay, they both won, and they might, maybe next time they won't both win, but to make 5% on your account with just 2 trades, where some traders will take hundreds of trades and that. I think the more trades they're doing, the more productive they are. But sometimes it's best to be out of the marketplace and to be patient. And I see so many clips on YouTube of traders who are making 10,000 a day, 50,000, just crazy figures, and sometimes just on one trade. And we've got to ask yourself is, how big is their account? Because they're not telling you how much they're losing. I've told you that I'm only risking 1.5%. They're literally not risking £10,000. That's not their whole account, £10,000. Okay, they're using leverage, to maybe make that £10,000 or £20,000 or £50,000, but you still have to have a big account. You're not going to get that much leverage to make 50,000, 20,000. You still got to have a fairly sizable account. They're not telling you how much they're risking. For most of us, you're not going to be able to do that. Okay, it sounds good and it gets views on the video, but it's not realistic. And I get a bit fed up actually seeing I made 20,000, 50,000 when they're not showing you the full picture. I'm showing you the full picture that I'm risking 1.5%. I made 5% on my account, and I think that is more realistic. So for me, it's been a good week. Not done much trading, but still managed to make 5% on my account. So happy days. I'll see you next time.